and welcome to Your Questions Answered. I'm Orla Tobin, a Senior Director at Goodbody Wealth Management, and I'm thrilled to be joined by our Goodbody Chief Economist, Dermot O'Leary. It's good to have you back, Dermot.
Thanks, Orla.
Good. This is the second edition of Your Questions Answered. It's a quarterly video where we ask Dermot your most pressing questions on the market outlook, the economy, and what to expect in the short term. We put a number of questions on LinkedIn, and we ask our followers to pick their top questions and the ones that they have the most votes on. So from that, we're going to ask Dermot your top two questions, and I believe there's a few comments asked as well. Will we kick it off?
Let's go. Yeah.
Great. So the first question at the top of the poll was, will there be more bank failures in 2023?
Yeah, I mean, this was the big, or has been the big surprise of 2023 to date. I mean, coming into 2023, I don't think many people were predicting that we'd get the sort of action in relation to the banking system that we have done, but there we are. I think it's important to distinguish between the US and Europe. There has been obviously a high-profile failure in the form of Credit Suisse in Europe, but that's looks like it's a one-off issue, and
hopefully,
indeed there has been a lot of pressure on that particular institution over the last number of years, to be fair. So it is a bit of a troubled child in a European sense, where there seems to be more systemic concerns to an extent is in the regional banks in the United States. And I think there's two reasons for that in particular. The main one has got to do with an absence of very strict regulation in smaller institutions in the US, stemming from a decision that was made by the US authorities around 2018 to reduce some of the restrictions and regulations in those particular banks. And I think that we're seeing some of the effects of that more recently in terms of what has happened with Silicon Valley Bank in particular, and there has been learnings from that particular failure. What's followed on since that is really a crisis of confidence from depositors in particular. So depositors are depositing money within a financial institution is all about confidence in the structures, in the capital structure, in the liquidity profile. So we have seen a bit of a crisis of confidence and a bit of a domino type effect. The Federal Reserve has tried to manage that domino effect, and they have come in fairly forcibly and fairly quickly in trying to stem that potential systemic problem. When I think about the risk to banks overall, you have an interest rate risk, and I think that came about in relation to Silicon Valley Bank in terms of the assets that they're holding. The interest rates went up, the asset values went down. You have now coming regulatory risk, because there will be more and more regulation and more cost upon these institutions. That's more of a profitability problem for the banks rather than a solvency issue. But where the biggest issue lies really is in terms of uninsured deposits or what's called generally liquidity risk. So to go back to the original question, will there be bank failures? There may well be. We look at specifically the risk of credit risk within the bank's balance sheets in the US regional banks, particularly in commercial property. So commercial property is going through a tough time at the moment because of structural but also cyclical reasons, got to do with interest rate risk, and I think that's where the biggest risks lie in relation to banks with bigger exposures to commercial property, and particularly that comes into the regional banks.
Right, lots to come. So the second question that topped the poll was, have interest rates peaked?
Okay, so again, there's a bit of a difference between what's happening in Europe and what's happening in the US. I would say in Europe we're not yet at that peak. It's become pretty clear based upon comments from some ECB Council members over the past couple of weeks that there's potentially 2 more hikes to come. So we're not yet at tight enough conditions for inflation to be quelled. And that makes sense because, where at the start of last year inflation was considered to be a US issue, now it's considered to be a European issue. So it's stickier. Food inflation in particular is having a bigger role, and the structural issues got to do with the labour market, the way the labour market works in Europe. That gives you more gives us more cause for concern and gives policymakers more cause for concern as well. When I look at the US, and it stems really from what we talked about there in relation to the regional banks, the stress that we're seeing in the US banking system. What that is doing is doing part of the final leg of the job for the Federal Reserve. It's probably leading to a tightening. It is leading to a tightening of financial conditions, which is probably equivalent to about a 0.5 percentage point rise in interest rates.
Okay.
So whereas we were thinking a couple of months ago that the peak in the Fed funds rate may be close to 6%, maybe 5.75. It looks like now we peaked at just over 5%. What we'll be watching for over the next number of weeks, even before the next Federal Reserve meeting, is that the Fed has given itself optionality in terms of if they see signs that inflation is not yet quelled, then they can go again.
Okay.
And also we're looking at the signs of, what's that wider stress coming from in relation to the banks. And then finally, I'd say, we have seen more positive signs on the inflation front, rolling over quite quickly. Some of the stickier elements are doing that as well. The one outstanding piece of that is what's happening in the labour market. There's still signs that the labour market is pretty strong, although it is showing signs of loosening. But I still think that this credit stress that we're seeing in the US has probably done the last leg of the job for the Fed. So I think we've reached a peak there. To finish up, the obvious question then is, where are we going after the peak?
Yeah.
The market's getting a little bit excited with itself on this one, so there's already a 50 basis points cut priced in by the end of the year. I think that's a little bit early. I think we'll need to see further confirmation in the data that inflation is indeed on a steady downward trajectory before we get the Fed jumping into cuts.
Couldn't too soon.
Yeah.
Okay. There was a comment in from one of our followers, Dermot, if you don't mind. Would love to know your thought on the risk to global markets if and when the USA defaults. So we're back to the USA again.
Yeah, well, look, this is the key question and the key concern for markets over the next number of weeks, next 2 weeks. The Treasury Secretary, Janet Yellen, put a specific date on it over recent days, in fact, saying that the US may run out of money if the debt limit is not raised by June 1st. Now, it's hard to be that specific about a date, but certainly it's pretty soon. Or else the US will have to take what's called extraordinary measures. What that means is delaying some payment of certain liabilities. It might mean delaying some issuance of extra debt. It might mean, and we've seen this in the past, it might mean a partial close down of government. We do have some precedent for this, over the last number of years, given the fractured nature of US politics. Probably the best example of it was back in 2011, where we did see a lot of brinkmanship. That was under the Obama presidency, and such that it didn't get to default. We've never had a default, obviously, in the US, but it got very close. And as it got to that particular crunch point, or X date as it's called, it did cause a lot of volatility in the market. So market volatility measured by VIX spiked. We saw an increase in credit default swaps, as we're seeing more recently. In equity markets, we saw a 17% decline in the value of equities.
Yeah.
So it's a pretty crucial couple of weeks. It would be almost unthinkable for the US to go into a default situation, especially in a situation where it can be avoided. So we hope that the President and the House Republicans can get together and hammer out a deal, let's say, over the next couple of days.
Do whatever it takes.
Yeah.
Okay, brilliant. Listen, Dermot, thank you so much. Very interesting. I've no doubt the followers will find it interesting too. If you have any further questions, please don't hesitate to contact your relationship manager in Goodbody. Thank you for joining myself and Dermot today, and we'll see you in the next quarter.